Imagine a stock that just plummeted over 10% in a single day.
Oh, wow. That's a big drop.
Yeah, it is flashing warning signs across the board, yet somehow some analysts are literally pounding the table calling it a strong buy.
That's quite a contradiction.
Right. Are we looking at a deeply undervalued hidden gem here? Or is this just the absolute ultimate value trap?
Well, when the price action and the underlying fundamentals are screaming two completely different stories,
Yeah.
someone has to be wrong.
Exactly.
And usually the market has a very brutal, very swift way of finding out who is left holding the bag.
That contradiction is exactly what we are unpacking today with Sidus Space.
Trading under the ticker symbol SIDU.
You got it. And as of today, April 20th, 2026, the stock is sitting at $5.35.
Okay, so 535.
Yeah. But before we get into the weeds here, I need to make the ground rules super clear for everyone listening.
Always important.
What we are doing today is an objective, natural debate of the source material. We are just analyzing the data, the charts, and the news. This is explicitly not financial advice.
Right. Definitely not financial advice. Our mission today is really to dissect the mechanics behind this specific standoff.
Because it's a weird one, right?
It really is. I mean, we are looking at a company facing some severe recent financial headwinds, yet they are simultaneously positioning themselves for these massive, almost unfathomable long-term potential contracts.
It's like two different realities.
Exactly. And we have to figure out how those two realities are currently coexisting in that $5.35 share price.
Absolutely. And hey, if you want to keep mastering the market with us, make sure you are subscribed to the feed
Yes, please do.
and leave a comment or a review. We read them all, and it is absolute compulsory that you let us know if you think this stock is a trap or a treasure.
You really want to know where you stand on this.
We do. So let's start with the immediate catalyst for this recent 10% daily drop. Sidus Space just announced a massive $58.5 million direct stock offering.
Which is, I mean, raising nearly $60 million in one fell swoop is a staggering move for a company of this exact size.
Yeah, the market reacted violently to that.
It did. It immediately started pricing in the reality of that news hitting the wire.
So let's talk about the actual mechanics of why the market reacted that way. Because a lot of people hear, raising capital and they think, oh, that's a good thing. They have more money.
Right, they think it means growth.
But this is a classic case of heavy dilution. Let's use a pizza analogy.
Okay, I love a good pizza analogy. Lay it on me.
So think about it like this. You and your friends pool your money together to buy a large 8-slice pizza. You each own one slice.
That makes sense.
Suddenly, the chef comes out, takes that exact same pizza, slices it into 16 pieces, and sells the 8 new slices to people waiting outside at a huge discount.
Ah, right, so you still had your piece of the pie.
You do, but your slice is mathematically half the size it was a literal minute ago.
That perfectly illustrates the mechanism of sheer dilution.
Right.
Because when we look at the specifics of this offering, the company is issuing millions of new shares, and they price them at $4.35 each.
Which is crazy because I just mentioned the stock was trading around $5.35.
Exactly. That offering price represents a steep 19% discount from the previous market close.
A 19% haircut is, that's a desperation move.
It really is.
You don't just slash the value of your own company overnight unless your cash runway is vaporizing and you need the liquidity right this second.
And the market knows that. So it instantly tries to reprice the current stock down toward that discounted offering price of $4.35.
Because why pay $5.35 if they just sold millions of shares at $4.35, right?
Precisely. Institutional underwriters demand a massive margin of safety when they're absorbing $58.5 million in risk.
Yeah, they aren't going to pay retail market prices.
No way. So they get the discount, the new supply of shares floods the open market, and the sheer volume of that new supply inherently suppresses the current share price.
So we really have to look at what is burning all this cash. If they need $60 million this badly, we need to open up the books.
Let's do it.
Looking at the full year 2025 income statement, it's a highly sobering reality check. Total revenue actually shrank by 27.58% year over year.
Wait, it actually shrank.
Yeah, they dropped from $4.7 million in 2024 down to $3.8 million in 2025.
Wow. I mean, in a sector where growth is basically the entire investment thesis, moving backward on the top line is a glaring red flag.
It's awful.
But the more illuminating metric is actually the cost associated with generating that shrinking revenue.
Oh, the gross profit.
Yeah, their gross profit for 2025 is negative $5.69 million.
Negative.
Yes, that equates to a negative 168% gross margin.
That's wild. It essentially means the core business model is currently completely upside down.
Right.
If Sidus Space sells a satellite service for a single dollar, it mechanically costs them $2.68 just to deliver that specific service.
And that's before they even think about paying for the corporate office executive salaries or, marketing.
Exactly. Why is it so expensive?
Well, the unit economics of early-stage aerospace are just brutal. The fixed costs are astronomical.
I can imagine.
You are paying for highly specialized engineering talent, huge satellite manufacturing facilities, rigorous testing protocols, and eventually reserving payload space on rockets just to get your product into orbit.
Right. Rockets aren't cheap.
Not at all.
Yeah.
It is a wildly capital-intensive phase for any company.
So when you factor in all those operating expenses, the bottom falls out completely.
Well, it gets worse.
Yeah, their operating income plummets to negative $28.01 million. And ultimately, the net income for 2025 sits at a staggering negative $29.47 million loss.
That is heavy.
And it's significantly worse than the $17.57 million loss they posted back in 2024. They are actively losing money faster while bringing in less revenue.
Which leaves them with an earnings per share, or EPS, of negative $1.19.
Which is not great.
No.
Yeah.
The income statement really just highlights the extreme capital burn required just to keep the lights on in the commercial space sector right now.
But here's the thing. The company isn't filing for bankruptcy.
Right. They're still operating.
If we shift over to their balance sheet from December 31st, 2025, they actually have a pretty solid foundation of assets keeping them afloat.
Okay, let's hear the numbers.
Total assets stood at $66.09 million against only $15.6 million in total liabilities.
Okay, that's actually decent. And the composition of those liabilities is super important too.
How so?
Well, of that $15.46 million, only $8.95 million is actual debt.
Oh, so they aren't drowning in toxic high-interest loans.
Exactly. They have relatively low traditional debt.
Right, and the most crucial metric here is the cash. At the end of 2025, prior to this new $58.5 million raise, they still had $43.2 million in cash and short-term investments.
So we are looking at a textbook early-stage infrastructure play here.
What do you mean by that?
They have a massive cash runway, but a blisteringly fast burn rate. They possess the capital to survive the immediate future, but they're incinerating it at an accelerating pace to build out their manufacturing capabilities.
They're just burning cash to chase those massive multi-year government and commercial contracts.
Exactly.
Now, with shrinking revenue and widening losses, traditional logic dictates the stock chart should be a straight line pointing down to the Earth's core.
Yeah, you would think so.
But it's not. The 52-week context on this stock is completely wild.
Let's talk about it.
We are talking about a 52-week low of just 63 cents, all the way up to a recent 52-week high of $5.99.
Wait, it went from 63 cents to almost $6.
It essentially 10x from its bottom.
That is unbelievable. The fundamental analysis and the technical analysis are telling two completely different stories right now.
Yeah, they really are.
The technical indicators are currently flashing anywhere from mixed to an outright strong buy.
A strong buy, even with the drop.
Yeah. The stock has experienced a phase of parabolic momentum, where the buying volume just overwhelmed any rational valuation metrics.
Let's walk through the mechanics of that momentum. Currently, Sidus is trading above its 50-day moving average, which is sitting at $4.69.
Right.
And it is also trading well above its 200-day moving average, which is way down at $3.03.
And that is a huge deal because algorithmic trading systems and technical traders monitor those averages religiously.
They do.
The 200-day moving average represents the long-term historical trend, while the 50-day represents the short-term momentum.
Okay, so when they cross...
Right. When a stock's current price is trading above both of those lines, and especially when the 50-day crosses above the 200-day, it triggers systematic buying.
Ah, the golden cross.
Exactly. The quantitative models are essentially signaling that despite the historical financials, The forward-looking trend has fundamentally shifted upward.
But riding that momentum is dangerous when a $60 million dilution event hits out of nowhere. We have to look at where the floor is now.
Where does the chart say the support is?
Immediate technical support sits at $4.90, which was a major resistance level they broke out of recently.
Okay.
But the structural floor is now clearly defined at $4.35.
Oh, right, because of the offering.
Exactly.
The new offering price of $4.35 acts as this huge psychological magnet. Because millions of new shares are being injected at that specific price, it creates a massive block of supply.
So if it drops below that, it's bad news.
Very bad. If the stock drops below that, the people who just bought the offering are immediately underwater. On the upside, the heavy resistance level they have to battle through is that recent 52-week high of $5.99.
What about the oscillators measuring the speed of these price movements? The 14-day Relative Strength Index, or RSI, is sitting right around 54.24.
Well, an RSI of 54 is incredibly neutral.
Really, just neutral.
Yeah. The alternate runs from 0 to 100, with anything over 70 considered overbought, meaning it might be due for a pullback, and anything under 30 considered oversold.
Got it.
Sitting right in the middle of 54 means the stock is essentially digesting its recent massive gains. It is resting.
But the MACD is telling a slightly more aggressive story, I think. The MACD sits at 0.261 right now.
Right, the MACD.
For anyone unfamiliar, the moving average divergence, the MACD, basically measures the relationship between a short-term moving average and a longer-term one. When the short-term momentum accelerates past the long-term trend, the MACD flashes a buy signal.
It essentially measures the velocity of the price change. At 0.261, that upward momentum is still mathematically intact, though the gap is starting to contract slightly after the dilution announcement.
Okay, that makes sense.
We also saw the stock recently breach the top of its 20-day Dilution channel.
Let's break that down. A Dilution channel is essentially just a box drawn around the absolute highest high and the absolute lowest low a stock has hit over a specific time frame, right?
Yes, exactly.
In this case, 20 days.
That is the exact mechanism. When the stock pushes past the ceiling of that 20-day box, algorithmic momentum traders view it as a tripwire.
Like an alarm going off.
Yes. It signals that a new, higher trading range is being established, which just triggers even more automated buying.
Which brings up the absolute most fascinating contradiction in this entire deep dive.
What's that?
If the chart is flashing these algorithmic buy signals, but the income statement is a total disaster, who is actually stepping up to buy the stock?
That is the million-dollar question.
Because we know it isn't the insiders. There has only been one recorded insider buy in the last 12 months.
Just one.
Just one. The executives and engineers inside the building are definitely not loading up their personal portfolios with Sidus shares.
Interesting. So the buying pressure is coming from institutions.
The big players.
Yeah. The institutional bias shifted heavily toward accumulation throughout early April. And this occurred during the formation of a technical pattern known as a rounding bottom.
A rounding bottom looks exactly like it sounds on a chart, a big saucer shape.
Right.
It shows a slow, steady exhaustion of sellers, transitioning into a quiet, methodical accumulation phase by larger players, before eventually curling upward into a new trend.
And institutional algorithms are heavily programmed to hunt for that specific transition.
They just wait for it.
They do.
Yeah.
They look for the exact moment when the panic selling dries up. They start buying in significant size to build their positions right before the momentum tripwires we just discussed get crossed.
So we have institutional accumulation and algorithmic breakout signals at total war, with shrinking revenue and a massive, highly dilutive capital raise.
It's a mess.
It is. I want to frame this as a debate for the listener. Is Sidus Space a deeply undervalued growth play ready to launch, or is it a classic value trap waiting to crush retail traders who don't understand the mechanics of what just happened?
Well, the broader analyst community is completely fractured on this exact question.
They can't agree.
Not at all. MarketBeat currently rates Sidus a strong sell
A strong sell.
because their models are heavily weighted toward fundamental performance. They look at the negative 168% gross margins, the massive net losses, and the shrinking top-line revenue, and they conclude the business model is currently unsustainable.
Which is a fair conclusion based on the math. But then bar chart flags it as a strong buy.
Right.
Their rating is driven almost entirely by the technical momentum, the moving average crossovers, and the institutional accumulation we just unpacked.
It's all about the chart for them.
And the most aggressive data point of all. The average one-year price target from the analysts who actually cover the stock sits between $10 and $10.20.
Wait, really? $10?
Yeah.
Reaching $10 implies nearly a 100% upside from current levels.
It's crazy.
To understand if that is even mathematically realistic, we have to ground ourselves in the current valuation. We really need to start with the bear case and the severe downside risks.
Let's do it. A lot of retail investors look at a low share price, like $5, and assume a stock is cheap.
Which is a huge mistake.
It is, because valuation is about what you actually pay for the business as a whole. Investing in Sidus right now is not like buying a neighborhood lemonade stand based on its daily sales.
Right.
It is much closer to investing in a pre-revenue biotech startup. You are paying a massive, astronomical premium today, entirely based on the hope that their one experimental drug gets FDA approval tomorrow.
That's a great way to look at it. Let's look at the hard data behind that premium. Sidus currently trades at a price to sales, or PS ratio, of 37.38.
37 times sales. Wow.
Yes.
To put that in perspective for you listening, a healthy, wildly successful, established tech giant might trade at 5, maybe 10 times its annual sales.
Exactly.
Paying 37 times sales for a company that is actively losing revenue is a staggering valuation.
It is. The company has a highly speculative market cap hovering around $355 million, which is entirely disconnected from its trailing revenue of just $3.3 million.
It doesn't match up at all.
Now, the price-to-book ratio is a bit more grounded at 5.6, but the overarching reality is that investors are pricing in absolute future perfection.
And this is exactly where retail traders often get trapped.
Oh, so?
Well, they see the stock plummet 10% in a single day because of the offering news, and they think, oh, it's on sale, I should definitely buy the dip. They don't realize the structural mechanics of the company have changed overnight.
Because the fundamental value of each individual share has been permanently diluted by that influx of new supply.
Exactly.
A lower share price doesn't necessarily mean the stock is cheaper from a valuation standpoint, because there are now millions of additional shares claiming a piece of the exact same company.
But hold on, if we go back to my biotech analogy for a second, if that experimental drug does get FDA approval, the early investors make an absolute fortune.
That is very true.
Sidus Space is actively bidding on a piece of a $151 billion government shield contract and a $120 million lunar contract.
Those are massive numbers.
If they secure even a tiny fraction of those deals, paying a 37 times multiple on today's tiny revenue is going to look like the absolute bargain of the century.
And that is the bull case right there.
Yeah.
It relies entirely on the successful execution of those massive paradigm-shifting contracts.
Right.
The SHIELD contract represents an immense defense and intelligence network requiring extensive low Earth orbit data collection. These are the kinds of deals that instantly transform a tiny microcap company into a major aerospace player overnight.
Which means the $58.5 million raise suddenly makes perfect sense in that context.
It does.
Yeah, think about it. You cannot sit at the negotiating table with the Department of Defense or prime government contractors if your balance sheet suggests you might go bankrupt in 18 months.
Oh, that's a very good point.
You need a massive war chest just to prove you have the liquidity to build the infrastructure required to actually fulfill the contract.
So the dilution is basically the incredibly painful medicine required to cure their undercapitalization.
Exactly.
By taking the 19% haircut today, they secure nearly $60 million in liquidity. That completely removes the existential threat of insolvency and allows management to focus purely on engineering, manufacturing, and closing those massive institutional sales.
So we have the two realities laid out here.
We do.
The bear case argues the fundamentals are a cash burn disaster, and the dilution mathematically traps retail buyers.
Right.
While the bull case argues the chart is establishing a new technical floor, and the massive cash infusion provides the literal rocket fuel needed to chase multi-billion-dollar government contracts.
That sums it up perfectly.
So let's synthesize this. What is the actual outlook for the listener who is trying to navigate this trade?
Well, if we look at the short-term perspective over the coming days and weeks, the defining characteristic will definitely be extreme volatility.
Brace for impact.
Arbitrageurs and market mechanics are going to pull the share price down to test that $4.35 offering level. The market physically has to absorb the new supply of shares before it can establish a true fundamental floor.
So, going back to the pizza, the market has to digest the 16 slices before it can figure out what the whole pie is actually worth.
Exactly. Now, if we look at the long-term perspective, this is the literal definition of a binary high-risk, high-reward scenario,
All or nothing.
basically. The survival and future valuation of Sidus Space depend exclusively on their ability to transition from a capital-intensive development phase into an execution phase.
Can they deliver?
Right. Can they convert the SHIELD and lunar bids into realized high-margin satellite data revenue? If they execute, the current valuation will eventually align with the growth.
And if they don't?
If they fail to win the contracts, the relentless cash burn will eventually catch up with them.
It is a fascinating high-stakes standoff between technical momentum and fundamental gravity. We've explored the cash infusion, the brutal gross margins, and the algorithmic buy signals.
We covered a lot of ground today.
But I want to leave you, the listener, with the final provocative question to mull over on your own as you watch this chart.
Let's hear it.
We established earlier that institutional algorithms identified a rounding bottom and stepped in to buy millions of shares right before this dilution event.
Right, the big players were buying.
Ask yourself, are those massive institutions truly holding for the long-term, multi-year lunar mission? Or are they simply capitalizing on the technical momentum, waiting for retail traders to blindly buy the dip so they can use that retail volume as exit liquidity on the next hype cycle?
Oh, wow. That is the ultimate question of market psychology right there.
It really is. Thank you for joining us on this deep dive into Sidus Space. It is a highly complex situation, but unpacking the mechanics behind the noise is exactly what we do here.
Sure is.
A final reminder to subscribe to the feed and drop your thoughts in the comments. We will see you on the next deep dive.